In this week's episode, we're talking about inflation in retirement and how you can protect yourself. Hey there, this is Patrick King with Prana Wealth. On this channel, we show you how to retire well. So if you're new here, please consider subscribing. And don't forget to check out our free retirement resources at pranawealth.com/resources. While inflation continues to be a concern for everyone, its impact on retirees may be the most significant. This week, we examine inflation and its ramifications for retirees. And don't forget to stay until the very end, where I go over some of the moves that you can make to protect your retirement. Inflation is the increase in the prices of goods and services and the corresponding decrease in the purchasing power of money. There are three main causes of inflation. Number one is demand pull inflation. When consumers have more disposable income, they tend to spend more, causing an increase in prices. Number two, cost pull inflation. When there is a scarcity of goods and services, prices tend to increase accordingly. And number three, monetary inflation. When governments print more money, a corresponding increase in productivity isn't immediate. This tends to drive prices higher. Right now, we're seeing spikes in all three causes of inflation. As of the end of October 2021, inflation spiked to 6.2% over the trailing 12 months. It was the biggest monthly rise in 30 years. So how does today's inflation compare to history? Since the BLS began measuring it in 1913, inflation has averaged 3.1% on an annualized basis in the US. Of course, there have been times where inflation was much higher. In the 1970s, for example, inflation ran at an annualized rate of 7.25%. It spiked to 13.58% in 1980 alone. More recently, inflation has averaged 2.14% per year, much lower than the long-term average since the Great Financial Crisis. I also think it's interesting to note that since the US left the gold standard in 1971, inflation has averaged 3.92% per year. This is a marked increase from the average of 2.46% prior to the gold standard being abandoned. And they say fiat money is just as good, right? So how does inflation affect your retirement? In retirement, inflation is your arch enemy. If everything that you need to buy keeps going up in price, then your money needs to grow faster than prices. It's not enough to say that inflation is bad. Let's do the math. If we look back at the average American retired household from our prior video, they spent $47,579 per year on average. Someone who is 60 today would need around $483,000 in investment assets at age 65 to fund that kind of spending. In those calculations, we assumed an inflation rate of 3%. But how would things change if it jumped to 4%? Instead of needing $483,000 in investment assets, they would now need $507,000, almost $24,000 more, to offset that extra 1% of inflation over just 5 years. They'll need to save an extra $300 every month between now and retirement. We can also look at this the other way. If they see an extra 1% of inflation over the next 5 years, they'll have to reduce their retirement spending by $80 per month for the rest of their lives. So what about cash holdings? Higher inflation makes holding cash less appealing. Because interest rates have been held so low for so long, it's given rise to the idea that there is no alternative to investing in risk assets. If your cash isn't yielding a higher rate than inflation, then your real purchasing power declines over time. When viewed in isolation, it doesn't make much sense to hold cash in today's environment. However, our decisions on cash holdings can't be made in isolation. Given the current extreme market valuations, it's perfectly rational to expect lower than average stock returns over the coming years. At some point, we will see some sort of correction. We always do. Remember, there have been plenty of long stretches in U.S. history where Treasury bills have outperformed stocks. In other words, while it may feel like we're getting punished for holding cash, it's not a decision we can make in isolation. We need to think about cash in terms of its liquidity for daily living and optionality when a buying opportunity presents itself. Fortunately, there are a few moves that you can make to protect yourself against inflation. Unfortunately, there's no magic bullet. If you have a mortgage, especially if it has a variable rate, you may want to consider refinancing if you haven't already. At some point, interest rates will need to rise due to these inflationary pressures, which could mean much higher interest payments. Just as with variable rate mortgages, you may want to consider paying down any credit card balances that you have. Culling your budget can also offset price increases in other areas. You can also investigate flat fee billing options from your utility companies. Consider stocking up on household staples if you haven't already. If they're going to be more expensive next month, why not replenish your personal inventories? Given our current supply chain issues, it may not hurt to have a little extra on hand anyway. When it comes to your investments, the best move is to add TIPS, Treasury Inflation Protected Securities, to your portfolio. Other asset classes such as commodities and REITs are also considered inflation hedges, but note that they can be volatile at times. Of course, we can't discuss inflation these days without mentioning gold or cryptocurrencies. Traditionally, gold has been an inflation hedge with a track record that extends back for millennia, while it may not be in vogue today. Conversely, cryptocurrency excitement is off the charts right now. There appears to be a future for cryptos, although I personally believe that they are overpriced at the moment. It's important to note that each person has a unique need when it comes to their portfolio. Be sure and consult with your financial advisor before making any portfolio changes. Inflation is the hill our retirement investments must climb to sustain us financially. Months and years with spikes in inflation are not uncommon in our history, but that doesn't make navigating them any easier. Unfortunately, there's no magic way to escape these periods of high inflation. The best strategy is to focus on doing the little things right. So what do you think? Are you worried about inflation? Let me know in the comments below. I'd love to hear your thoughts on this. Hey, if you found this video helpful, please help me grow my channel by liking this video and subscribing to my channel. And don't forget to check out our retirement resources at pranawealth.com/resources. If you need help protecting yourself from inflation in retirement, then visit us at pranawealth.com to see if we're a good fit. We can and do work virtually with clients all across the US, and we're here to help you whenever you're ready. Thank you so much for watching, and I'll see you in the next video.